I now welcome representatives from, well, actually one representative, the other didn't turn up, from Liberty Works. I understand that information on parliamentary privilege and the protection of witnesses and evidence has been provided to you?
Yes.
Okay. For the Hansard record, will you please state your full name and capacity in which you appear today?
Yeah, Darren Brady Nelson. I'm here on behalf of Liberty Works. Just to also, for the record, I do currently work for the chair, the senator, but I'm not here in that capacity. On the board of Liberty Works, I'm also the chief economist for Liberty Works.
Okay. So I have to confirm that, and I was going to declare that anyway, that Mr. Nelson is on our staff and will be for another 2 weeks before he returns to America. And I now invite you, Mr. Nelson, to make a short opening statement, and at the conclusion of your remarks, I'll invite members of the committee to ask questions. And I have to add, of course, that this submission is not from me or from you, it's from Liberty Works.
Correct.
Which you'll explain what Liberty Works is, I trust?
Yeah, it's been signed off by the president of Liberty Works, Andrew Cooper. Before I, just a quick one, just before I forget, Senator Williams was talking about APRA. In our submission on page 15, there's a couple of pertinent sort of graphs of statistics, which I'm not sure what page that is in your pack, but it shows basically, if you like, the amount of money that's being lent out versus is actually sitting in the banks. It's a fairly low percentage, basically. It's well under 10%. It also shows the dominance in a different graph of, I've labeled it as the big five banks, so that's Macquarie, in addition to the other four, how much they dominate the Australian market compared to everybody else. So
as I read that, Mr. Nelson, the bottom graph on page 15 shows that the big four or big five have over 70% from 2002 until 2009, and then after the global financial crisis, increased to now be over 80% of the banking.
Yep, that's correct. Whether you look at it in terms of loans or whether you look at it in terms of deposits, it's about the same.
And the first graph you drew our attention to shows that the amount of money is 10%, deposits are 10% of the amount of money.
Yeah.
Is that correct?
And these are APRA statistics. So obviously APRA can speak to those in greater depth at the appropriate time. Another thing, just quickly up front before I get into my presentation, which I believe everybody has a copy of, I would strongly agree with Ellen Brown's analysis of money and banking, and it's definitely the way it's done in Australia for the most part. There are some differences. What the Reserve Bank is slightly different than quantitative easing, but they have been printing money like wounded bulls for quite some time. I disagree with her policy conclusions. I don't think the solution is more government and more regulation, and I'll get into that. So just to give you a bit of introduction, and I should say thank you for the opportunity today to testify before the committee. I've already told you who I am. A little bit more background on me is prior to working for the senator, I worked at the presidential campaign for Trump. I've been a freelance professional economist for many years. I have degrees from ANU and University of New South Wales. Nowadays, I'm kind of more of the Austrian school rather than the mainstream schools, but I know both quite well. Hopefully, during the course of my testimony today, essentially I'm going to lay out the economic logic and evidence for my views, which I believe backs up, if you like, my provocative title to my presentation, which is called Banking Bad, the Buck Stops with Big Government. So I guess I'm echoing, you have a system problem, and the banks are just operating within that system. They very well may encourage this system, they may love the system, but at the end of the day, it's not their system. It's the system of the government, and particularly the central bank as well. I will just say some stuff a little bit out of order, because I think it's important. Basically, I set out my presentation, introduction, obviously. I go through some of the issues, some analysis, and I provide some support for my views. And then I come to some recommendations. But before I get into that order, I'd like to say, just, people kind of think, oh, this stuff is a little bit out there or something. In America, it's actually not considered out there at all. Actually, most Republican politicians know this, and they'll mention this. This is not considered, oh, wow, this is a bit weird. It's not considered weird. You can disagree on whether it's good or bad, but it's not considered odd. In Australia, it's just less known. But there's two significant politicians who can attest to this system, and that's former Treasurer Peter Costello and also former Prime Minister John Howard. Now, that's set out in my slide called Support One, Politicians. Peter Costello in The Australian in July said, "Sometimes I wonder whether those running the banks realize how important the government is to their business. Who benefits from this tightly regulated enterprise? Well, the government does, the shareholders, of course, and the senior executives employed on handsome salaries to keep their operation ticking over. It's the consumer that is feeling unloved." John Howard, admittedly a long time ago, in March 1999, in some correspondence between himself and a concerned citizen, the citizen asked, "Does the coalition support the system where the banks can create money out of thin air?" Howard, yes. Citizen, well, will the coalition pass the laws to forbid the system, which is very clearly a fraudulent one? And just to add, fraudulent, he means, I guess, more in a moral sense. It's actually not fraudulent in a legal sense. Howard replies, no, and it is not fraudulent. And he's meaning in a legal sense, which is true.
So, Mr. Nelson, just to hold up there, Mr. Cusack in his submission, Ellen Brown in her submission, she only implied, but if you did this, what the banks do, then it would be fraud.
I'm unaware of any other industries that are allowed to do this. So this would normally, under common law, would be fraud. But common law is overridden by legislation, and that's what's happened.
And same in the UK.
Every Western country.
Thank you.
And not just Western countries, Russia, China, etc., India. The citizen goes on, does the coalition recognize that the primary cause of the current recession was the huge credit creation binge that followed deregulation? This increased the money supply so massively it created a false boom. Howard, he goes, yes, but the binge, not deregulation, was the cause, which I would agree with as well. Citizen then finally asks, does the coalition recognize that increases in the money supply causes inflation and a false boom, and that inflation erodes the value of people's savings and encourages people to spend instead of save, and that inflation is stealing the wealth of all Australians? Howard, yes. Also in support of my presentation, it's also worth pointing out up front that I provide two extremely reputable and respected economists, one, if you like, from the right, Milton Friedman, who won a Nobel Prize, and one from the left, Lord Maynard Keynes. Milton Friedman said, and he's actually done the most extensive study of money and banking in history that's ever been done, and he said, inflation is always and everywhere a monetary phenomenon in a sense that it is and can be produced only by more rapid increase in the quantity of money than in output. Not too many people would claim that Milton Friedman's a bit wacky. And they certainly won't claim that Keynes is a bit wacky. And he said, and he didn't win a Nobel Prize because they weren't giving Nobel Prizes out at the time. He probably would have got one. So Lord Keynes said, by continuing process of inflation, governments can confiscate secretly and unobserved an important part of the wealth of their citizens. By this method, they not only confiscate, but they confiscate arbitrarily. And while the process impoverishes many, it actually enriches some. That's why you have that system. Now, to get back into the order of my presentation, on my slide entitled Issues 1, the Drivers, it is the macro-level issues of money and banking, which I've already started to discuss, that ultimately drives and sustains most, if not all, of the micro-level problems that you see in rural lending. So you can't completely separate them. And they're not really separate, to be honest. The key macro-level issues arise as a result of government failure, not of market failure. It's about government control over market freedom that leads to the problem. And in particular, what I'm talking about is there's a plethora of government legislation and regulation that make this all possible. And in particular, it makes three things possible. It provides a central bank monopoly for the Reserve Bank. Nothing unusual, of course. This is in virtually every country. But yet it's a monopoly on money, at least at the bottom of the chain of money. It essentially gives a license to create money out of thin air, which is economists call fractional reserve banking. And it also allows for, if you like, the cartelization of the banking industry by, I've labeled it Big Five. I guess in the context of world banking, it's really a Big Four, and we all know who the Big Four are. It's the ANZ, Commonwealth, National Australia, and Westpac. The Big Five includes Macquarie, but they're not particularly involved, I believe, in world banking, as I understand. But they are heavily involved in the broader banking industry. The impacts of this, well, these macro-level issues, as I said, drive the micro-level problems. Essentially, it makes easy money and credit available, and that actually provides a strong disincentive to be efficient and ethical. Basically, the banks don't really have skin in the game. So when you're asking questions, when they lend out $1 million, that's not even deposits. So they obviously behave a little bit. If it was deposits, it was their money, they were responsible for it, and had to give it on demand, you'd see them behave a lot differently. They also get disincentivized, obviously, by the fact that they don't really have to compete properly with the other banks in the Australian market. And this leads to all sorts of stuff like these one-way contracts, which is very odd. I mean, and again, probably if common law contract wasn't overridden by this legislation, they'd never get away with contracts like this. Contracts are always written in a fairly win-win way. Sure, there's disputes once in a while, but you wouldn't have like rampant one-way contracts, where, you've been making all your payments, but we're still going to take your asset back. That's just, absurd sort of thing. That wouldn't happen in a normal setting. And the common law, in history was really, when people talk about the rule of law, they talk about the common law. That was the rule of law. Nowadays, with all this legislation regulation, that's actually being ruled by laws. And actually, you're actually more being ruled by a bunch of people as opposed to the rule of law. The players, we've mentioned some of them. The Big Five banks, probably more the Big Four, the Reserve Bank, and the institution of government. I'm not highlighting that, it's not a coalition thing, it's not a labor thing. Both have sort of presided over this, but government really is the key. Because they create the legislation. The Reserve Bank is created under legislation. In the U.S., the Federal Reserve is created under legislation. I disagree with some people. To me, it's irrelevant whether it's private or publicly owned. They behave exactly the same. Doesn't matter.
So you're saying the key is the central
central
laws. Bank system.
It's the laws.
Sorry,
the fact that the Federal Reserve is privately owned is largely irrelevant. It's a government-controlled entity at the end of the day.
So you're saying the laws that enable the monopolization or the cartelization?
Yeah, because you just wouldn't get it without those laws. It wouldn't last for any length of time. In fact, just as a broader point, I majored in economic history, you can point to nearly no examples in history where monopolies and cartels survive for any length of time without government backing. They always have government backing. Microsoft's a classic example. No government backing. What happened to Microsoft? They have to compete. They dominated, but they actually had a cheaper and better product for a long time too. Same with Apple. So this system grants uneconomic and unethical power to the Reserve Bank and the Big Five banks. And power corrupts, as it always does. Now on to analysis one, failure. So as I mentioned, it's government failure, not market failure. That's the problem. And government failure and this concept is actually a very mainstream economics concept. So it's not, I'm kind of more of an Austrian school, which is obviously a smaller school of thought, but the mainstream talk about how government fails, and it fails all the time. It's called public choice theory. And in particular, quoting from a couple of professors from the Mercatus Center in the US, they go, market interventions may produce government failures. That is, even when a market failure is observed, a particular government intervention may produce even more inefficiency than the status quo. As a result of the rent-seeking problem, unintended consequences are both. We see that all the time with regulations of various sorts. I don't have this in my presentation, but remember this phrase, Baptists and bootleggers. This is behind virtually every regulation. And it's not conspiratorial. It's just the incentives are there. So the Baptists are the true believers who think, regulations are in the public interest and they're always in the public interest and that's what they achieve. Okay, fine. I disagree, but people do believe that. And the bootleggers are the people who know they can actually earn more profits from this system. And the banks are clearly that. And they're not alone. It's not the first in history to do this, that's for sure. And the Baptists and bootleggers phenomenon refers to the 1920s prohibition on alcohol. So the Baptists really believed that alcohol should be banned. The bootleggers made a buttload of money out of it because it was better because they didn't have to compete with legal alcohol. So eminent economist Ludwig von Mises, which I have a quote at the beginning and at the end of my presentation as well, wrote, government intervention suffers not only from a problem of incentives, but also a problem of knowledge. In other words, government cannot engage in economic calculation, prices, all that sort of stuff. That system doesn't, government doesn't have that system like the market does. And he added, in terms of bureaucracy, he goes, the failure was certainly not due to the incapacities of the personnel. So it's not like these people are bad in government regulators or whatnot, or in the Reserve Bank. It was an outcome of the unavoidable weakness of any administration of public affairs.
So you're saying the system is at fault?
It's the nature of the beast. The more you get government involved, the more you end up, rather than helping everybody, you tend to actually, and Friedman, I don't have this quote in here, but he's got a great quote when he basically turns around the Adam Smith quote of, how the market through the invisible hand leads to benefit everybody. He says that basically the visible hand of government ends up hurting most people, actually not helping most people, even though it's well-intended. Doesn't matter. Just the nature of the beast. And Milton Friedman's written about this.
Your term, Baptists and bootleggers, that's a Friedman term?
No, it's actually from a professor from the Mercatus Center who came up with that term. It was, analyzing, the 1920s prohibition of alcohol, but then applying it to a whole host of different areas. So one of the key things, onto my analysis number 2, many of the greatest economists of all time have recognized the massive economic dangers from large increases in the money supply. And that's usually goes hand in hand, both the central bank and the banks. So it's basically a bit of money printing plus this creating money from nothing for credit, from the fractional reserve banking. So one of the key things it does, and this one people are a little less aware of, is that it's actually the main driver of the business cycle, which is actually shouldn't be called the business cycle because it's not really business. Business goes along with it because they're incentivized to go along with it, cheap credit, all that sort of stuff. But it's actually a government and central bank caused cycle. And if you think like, oh, wow, that sounds a little crazy, are you sure? Well, Friedrich von Hayek got a Nobel Prize in economics for that exact insight, that it's a monetary phenomenon. And Friedman would agree, too.
So correct me if I'm wrong, Ron Paul, the respected senator and member of the House in America, he has been citing that the so-called business cycle is really a credit creation and contraction cycle. So it's really money supply,
Correct.
Inflation, money supply, contraction, money supply,
Yeah.
inflation, money supply, contraction. And that is exacerbated by people then going into booms and busts.
Yeah. And in fact, exactly, and it's been worse and more persistent since, like the central banks were set up and stayed in the 20th century. But we've had central banks in the 19th century and earlier, and every time they popped up, same thing happened. You can even go back to the tulip, and all these other so-called market phenomena. They're not market phenomena. It's government and central banks interfering in the monetary system every single time, and that's listed in there. I give you some references for that sort of thing. It's not a market phenomenon. Markets don't usually fail in such mass, without government intervention. So the cost of living, just to add, is not inflation, but is caused by the inflation of money, and also made a little bit worse by, if you like, the inflation of government, taxes and regulations.
Well, isn't the term inflation actually referring to not prices, but refers to the inflation of money supply?
Yeah, and that's the term that economists use for like 150, 200 years. It's only in recent decades that people start calling inflation either the prices or the measure of those prices only one measure, consumer price index. That's not inflation. Inflation, and I'll get to this, will be something like money supply, M3 or something. That's actually inflation. Now, then it affects prices, and then it'll show up to some extent in CPI, but not completely show up in CPI. Well, I'll get on to later.
Isn't inflation a situation where demand exceeds supply, and as a result of that, prices rise?
That's a Keynesian point of view, so I would disagree. No, that's... Hey?
What point of view? That's
a Keynes point of view. That's the school of thought that that it's driven by something like excess aggregate demand. But Friedman, Hayek, they would disagree with that sort of assessment. There is a demand for money.
I'm talking about general demand in the economy for goods and services.
Yeah, no, I understand what you're saying. No, I disagree with that. That's not the reason. That's not the reason.
And would other economists disagree with what you're saying?
Yeah, there's economists who disagree with that, yeah.
So the economics I learned at school must have been wrong under your book.
Sorry?
The economics I learned at school must have been wrong under your book when I was taught that inflation is a situation where demand exceeds supply.
Yeah, in my opinion, yes, that's incorrect. That's what I learned at ANU as well, what you learned. But I've come over 20 years of actually doing this in the context of Treasury, think tanks, et cetera, to realize that theory is incorrect. It was a theory, and it doesn't hold up.
Will you be addressing that?
Not specifically.
No. But you are talking about...
But I will tell you, later on, I'll tell you what I think is the better understanding of if the demand and supply for money.
In your submission, you address the money supply driving inflation.
Oh, correct. Sorry, yes. I don't literally go into the details of why the Keynesian theory is incorrect.
The way I read it is that the money supply is inflated. That drives prices higher.
Correct.
Okay.
Yeah. So and I'll get to that a bit later.
Okay, I'm sorry.
And as as the quote from Keynes himself, interestingly enough, this creates winners and losers. It's there's mainly losers, but there are some winners. On to inflation. Just to note, there isn't a one-to-one relationship. If you jack up the money supply by $100, doesn't mean you're going to get $100 more of prices inflation, because there is a demand side to money as well. But it is important to note, you probably would have learned at school also, that somehow we need more money because the economy is growing. Well, there's a lot of very eminent economists who say, no, that's not the case at all. Not only in theory, but in practice, you do not literally need more pieces of paper to facilitate economic growth. In fact, the 19th century was largely a century of deflation. So the money supply was relatively constant for most of the part in Britain.
19th century or 20th century?
19th century.
So back in the 1800s?
Correct.
Yep.
And it was actually also the greatest century in human history of economic growth, real economic growth. In other words, take inflation out of it, and wow, that was impressive. For Britain, the US, and Australia was, unbelievable. Went from, poverty in the real sense, not a relative sense, but an absolute sense, to, hey, everybody's doing pretty well. We're surviving. We're not subject to many diseases. We live in homes. We have good food. That's that type of wealth.
But that would be logical in Australia because the country's being developed into agricultural exports, etc. So that's not surprising, is it?
No. But a lot of economists will argue the fact that they had a stable money supply helped with that. Not the only reason, but it helped. It was a gold standard back then, and there wasn't. Gold stayed relatively the same for the most part. It was often people would exchange pieces of paper, but they were backed by gold. So that's that with inflation. Here's a quick one on analysis number 4, decay. So when you do start jacking up money and credit, businesses in particular tend to face 3 choices. And this is according to Dr. Gary North, who's an economist in the U.S. and wrote a book called Honest Money. He says, firstly, businesses have to sell the same goods at the same price and get stuck with the now inflating and devaluing currency. Not a great choice. Number 2, sell the same good and service at a higher price. But unlike people you hear in the media, it sounds like businesses can just pass on the costs and jack up their prices. No, they can't. Unless they're protected like a bank or some other industries, you can't just whack your price up because you'll lose sales and lose revenues and profit. So that's not a great choice either. Third choice, and this is what usually happens, more so than the first or the second, is you can sell a lower quality good or service at the same price. And there's plenty of evidence to suggest that's been happening in Australia, the US, and other places where they've been inflating the money supply. And that it becomes a moral dimension too. You know, you're essentially ripping people off. It's probably legal, but it's not a good thing in your economy. You know, you're going backwards, or you're certainly stagnant, and you're not really going anywhere. The next slide I've already covered at the beginning, which was, you know, my first slide on support, where I quote the politicians. Although I didn't get to a very interesting exchange between Senator Roberts and Treasury Secretary John Fraser in May this year at the Senate budget estimates. The senator asked, "Isn't it the case that such money supply inflation has been the key driver, at least on the demand side of the economy, of the rising consumer price index in recent decades?" Secretary Fraser goes, "Well, it is a hard one. I do not have an answer. I'm a traditionalist, so I see money base growing like this, and it worries me. But every time I carry on and talk about the inflationary impact, everybody laughs and says, 'You're showing your age,' which I am. That is a non-answer, but it is interesting, and I know that a lot of the people and treasuries around the world look at it and say the same thing. We do not have an answer." I love that honesty, but I'm surprised by it, but it's brilliant. On to some further support. I already mentioned the economists. I mentioned Milton Friedman. We've given you 20 sort of further sources, that backs up sort of our views, and that includes 3 in particular: Milton Friedman and Money Mischief, which is based on his work that he got a Nobel Prize for, understanding how money and banking have worked through the past couple centuries. And also an Australian reference, Chris Leithner, who comes to the conclusion in his book, is rather a thick book actually, the RBA doesn't fight inflation, it manufactures and maintains it. So, yeah, and I would agree, maybe I won't say it quite as strong as that, but, this thing you get in the media, the Reserve Bank fights inflation.
That's no secret.
It is a secret to most people.
The RBA wants inflation around between 2 and 2.5%, right?
I'm not sure what its current target is, but that sounds about right.
Around there. And when it's down to 1%, interest rates low, and they try to stimulate the economy to get it back up. They want to see inflation run around 2%. They are the targets. That's no surprise. That's common knowledge.
No, but people don't quite understand that because they're using the term inflation in its popular sense as opposed to its technical sense, which is a bit disingenuous for the Reserve Bank, which is full of economists. Or they should at least go, okay, link the two together. Hey, here for you, the public, this is what we're saying, but also for you, the economists, and then we can link the two together so they give a more truthful picture of what they're actually doing. As I'll get next to the statistics, well, they're allowing the money supply to be inflated by a heck of a lot more than that percentage. And in fact, even the CPI, I give you ABS's statistics, it's not a pretty picture. Even CPI is going up. And it's not something that, they tend to present it like on a quarterly or a monthly basis. Oh, that doesn't look so bad. But it's like compound interest. It adds. So it is pretty significant. So the CPI, and everybody knows the cost of living in Australia is out of control. And this is a big part of it. Not the only part, but a big part of it.
So that's your graph on support 3 statistics.
Yeah. So basically I juxtapose ABS statistics for CPI, both as it's accumulating over time, but also its year-by-year growth. And then I show one measure of the money supply. Most economists think M3 is the best measure, but you can debate that. That's fine. M3 is a combination, if you like, of the money that the Reserve Bank is responsible for, but also that the big banks are also. So it combines the two together. And you can see it's growing exponentially.
Chair, just an issue. We've got about 15 minutes till we break for morning smoko. With this witness, are we allowed to ask any questions or we sit here and listen?
I understand he was going to do a submission, presentation, and I can see it's going on longer than I would have anticipated, so I would suggest you ask questions anytime you want, Senator Williams.
Yeah, good.
Oh, could I at least just get to my recommendations, and I'll just jump ahead to that, and then I'll take some questions. So basically, there's a few more slides, but the recommendation is in 3 parts. We think there should be a Royal Commission or something like that, focusing on the things I've discussed today. Also, hopefully coming out of that, there's some comprehensive reform agenda, with a reasonable time period to implement that, and hopefully maybe something along, maybe doing that in a way that was done with national competition policy is a pretty good way. I think those were some of the best reforms Australia's ever seen. So that type of process. That's it.
Senator Williams?
Yeah, thanks, Mr. Nelson. So you're saying banks can lend money and they do not need any money in the bank, correct?
Oh, they only need X amount of percentage in the bank. I believe, as I understand, it's driven by things like Basel III, things like that.
Right. So let's just keep it simple. If they've lent out $1 million in their total book, how much money do they have to have in the bank available to them?
I understand that it's, and I think the APRA statistics show something of because I understand the Basel III doesn't set like an exact pinpoint number, but it tends to be something between 5 and 10%.
Right. And so they would not want any more than that, would they? It only cost them money.
Yeah, within reason, they tend to go to that limit, or at least close to that sort of. I think it's called the minimum reserve requirement.
Well, after the global financial crisis, when the government guaranteed the deposits into all ADIs up to $1 million, there are many reports saying that up to 60% of the money banks lending were from domestic deposits, the highest ever for many, many years. Was that true?
I'm not sure, to be honest.
Well, if they only need about 10% of the money they lend, why do they carry out securitisation?
I'm not familiar with the I'm aware of the concept of securitization, but I would be starting to talk about something I don't know a whole lot about.
But you're an economist.
Yep.
With what sort of what do you specialise in?
Me, I specialize in mainly things like competition policy.
Right. You're not familiar with securitisation?
Oh no, I'm familiar with the concept, but I'm not a banking economist.
Now, the point I make is the bank only needs, as you say, 10% of the money they lend. They've lent a total book of $1 million, only need 100,000 in the bank or access to it. Why would they encourage or why would they pay people to put their money in the bank if there's more than 10%?
I'm not familiar
with what's been happening. It'd be a cost to their bottom line, wouldn't they?
Sorry, say that again?
It'd be a cost to their bottom line if they didn't need the money in their bank. What I'm saying is if they lend money out of 4%, why would, if they're above that 10% threshold of what you say they need in the bank to lend for their whole book...
Well, if the economy's looking...
Hang on.
Yep.
You've had enough to say. Can I have some? Why would they pay people 3% to put the money in the bank?
I'm sure you'll have to ask the banks that. Because, these are
But under your theory, they wouldn't need it. Why would they carry out securitisation? Why would they carry out wholesale funds, borrow them from overseas? They wouldn't need it. They could just create the money out of fresh air.
What I've highlighted is the overall system, not the specifics of securitization, and the economic incentives that these banks face. Now, they have to act on these economic incentives, and they have to do their own profit calculations for each loan. So you'll have to ask the banks why they don't always lend out to the max that they actually could. We found that in the U.S. as well, because a lot of the banks, the economies here and the U.S. has been stinking it up for about 10 years. So, they are lending out quite a bit, but not as much given what they could lend out.
Senator Williams, when we had APRA, ACCC and the RBA in, I think you asked a question to clarify Dennis Fay's evidence in Charters Towers, and you asked a question talking about securitisation. What I learnt, amongst other things from them, what I can remember at the moment, is that securitisation, when an institute, when a bank's securitized, they had to pass on 0.5%. Well, that's much cheaper than...
They didn't have to pass, or they may have chosen a margin when they sold those bunch of loans off. I suggest they probably keep a margin on it.
Right. So...
Yeah. So in other words, if you lend a heap of loans at 5%, and and you're paying investors 3% to put money in the bank. When they sold them off, they might have sold them off at 4.5% and kept 0.5% of cream off the top. Then when they get the basic principal back, they lend that out again.
So wouldn't securitisation be a cheaper way of doing it?
Well, it's one way of raising funds, but under this theory, they don't need the funds. This is what I'm saying. Why would they do it? If they can just create money out of fresh air, why would they carry out securitisation? They don't need it under your theory. So why they go down this road of securitisation if what you say and our previous witness says they can just lend money out of fresh air? Why do they need securitisation? This is where I'm baffled.
Well, as I understand it, Mr. Nelson...
Because they don't need the money in the bank,
that's what
under your theory.
That's what the Bank of England has stated, according to quotes cited by Mr. Cusack, and that's what Bundesbank and Bank of England have stated, according to the previous witness.
Oh, it's hugely documented. There's
What do they say?
next to
They
no
don't need
there's
the
no
money.
doubt that this is how the banks
point,
operate.
Chair and Mr. Nelson.
Sorry?
If you're saying the banks can just lend out squillions of dollars, they don't need money in the bank, why do they go on a mission to get money in the bank? They pay people to put money in the bank?
Because the more money they get in, they
Hang
can
on.
lend out at the appropriate reserve rate. So, if it's that 5 or 10%, the more money they get in, the more they can at least potentially lend out. Now, they don't always do it if they're not comfortable with some of the people who are coming to them for loans.
Well,
But your question's more better directed to the banks.
After the GFC, when people pulled their money out from under the bed and from the stock market and from everywhere else and put them in the banks because they were guaranteed by the government,
Yes.
they were flushed with domestic savings, the highest for decades. Why did they do that?
Well, I think Ellen Brown sort of said it quite well. The banks, I'm not sure if I would have said it the way she did. That she said, well, it's kind of actually the people borrowing the money who kickstart that process of creating money, if you like, out of thin air, because the banks can't just create money unless there's a loan. So if people aren't demanding the loans, or the people demanding the loans just don't, cut the mustard in the bank's view, well, they're not going to lend out the money.
Well, I'm sure after the GFC, people were demanding loans, probably many extending their loans because they're in financial trouble. Yeah. Thanks, Chair. That'll do me.
You continuing, Mr. Nelson?
Actually, one thing that's quite interesting, I think, and it's worth putting on the record. Excuse me, let me just bring this up. And it's in the submission that we put in. Professor Murray Rothbard also importantly showed that after a series of British judicial decisions in the 19th century, deposits henceforth belong to the banks as loans rather than bailments for safekeeping. Amongst other things, this facilitates the massive mismatch between the time structure of bank assets and liabilities, i.e. shorter-term deposits on demand, with longer-term credit on loan. That would normally not be a very good market outcome or a good business model to have. In other words, you can get bank runs. Mm-hmm. And this, and like most, sort of particularly in the 19th century, any British legal precedent is usually a precedent here.
Just one question I might add there. I mentioned about after the global financial crisis, when the Rudd government guaranteed any deposits in ADIs up to $1 million. They also had another system where borrowing overseas wholesale funds, the government guaranteed those institutions when they borrowed, guaranteed the people overseas that if the institution fell apart, the Australian government would guarantee it. That those institutions paid a premium to the government. Why did they do that if they didn't need the money?
Well, not to sound like a broken record, you're going to have to actually ask the banks, because these are individual business decisions. But I'll tell you this.
Now, why
I'll get to it.
Why did the government do that?
Why the government?
I'm curious to know.
I have no idea why the government did it.
Why did the government guarantee the borrowings of our big four banks from overseas after the global financial crisis?
No idea why the government did it.
Perhaps it was a rort for the government to make some money on the premium.
But you can, the banks can, even though this system basically is in every country, but the particular circumstances and the differences in all sorts of economic factors, you can actually if you like, get cheaper money overseas, and that would be the reason why you might want to borrow overseas. Doesn't take away from the fact that if you're borrowing money from the U.S., you probably, again, for every $10 you borrow, there's probably only $1 of deposits that's actually behind all of that. That doesn't change that fact. So the economic system is the same. Now you're asking me like specific government policies, I don't know, why they did what they did, or you're asking me specific business decisions of the banks. I don't know exactly why they, they did what they did.
Perhaps the government at the time was a little concerned that our big four banks would have some trouble borrowing overseas and wanted to guarantee that so they were safe. Because it was a pretty hairy time.
Yep.
We had banks falling over,
Yep.
Lehman Brothers, the banks in Ireland, the government had to bail them out. And luckily our big four banks had AAA credit ratings. There were only 11 in the world at the time and 4 of them were in Australia. So I question why the government did it to guarantee it. Was it to bring stability and security would be the question I would ask. I'd say yes.
Well, because it's a house of cards, and it would have fallen over. Not the whole banking system, because there was plenty of sound banks, particularly around the world. In the U.S., if you look at who they bailed out, they didn't bail out the system. They only bailed out the connected banks, the ones who had good connections with the U.S. Treasury. That's who got bailed out, not the whole system.
So Lehman Brothers went under.
There's a lot of banks in the U.S. Not many got bailed out.
So as I remember it, Lehman Brothers was allowed to go under.
Yeah,
but the next one on the rank was propped up.
Yeah, basically, if you had connections with the Treasury, you got bailed out. If you didn't,
you died.
You didn't.
So Senator Williams, I think I wonder how much of the Rudd government's decision to prop up the banks was a political decision, because the whole of his response to the GFC was denied as unnecessary by the coalition at the time, which was in opposition. And a lot of economists said it was not needed either, because we were doing very well thanks to the mining boom and so on.
Well, a lot of his stimulus package was clearly a waste of money in many respects, but that's a political argument, not for this committee.
Right.
We're looking at the banking industry in relation to primary production.
Well, as you very well know, it's not the first time politicians dressed up their political ideas in the public interest. Oh, the banking industry as a whole is going to collapse. No, it wasn't actually. The bits that were going to go under should have gone under, but only Lehman Brothers and a couple were allowed to go under.
So, Mr. Nelson, it seems that you have two aims. One is to get justice. Liberty Works. When I say you, Liberty Works has two aims. One is to get justice for what has happened in the past, and you are advocating a royal commission.
Correct.
And the second aim is to change the system to prevent recurrence of the past injustices. Because if you don't change the system, you'll continue to get the same behaviour.
Yeah, you could swap out the current 4 or 5 banks, stick in some new ones, and you'll end up with the same problems down the road.
Okay.
If you don't change the system.
Thank you. And you have 3 recommendations which are clear.
Yeah, and I put some timelines. Obviously, they could be flexible, but I just thought, just to be a bit precise, give some actual timelines.
Could you go through those timelines, please?
Yep. So basically, we recommend, because I understand this committee will come to a conclusion and release a final report in October. Is that still the case?
It's been extended to the end of November.
Okay. So basically, we thought a year would be about the right amount of time for a royal commission or something serious and similar, possibly getting, a credible outfit like the Productivity Commission or something like that, who can't just sweep things under the rug. And I think there should be, as part of that, and this is what's happening in the U.S., they're starting to institute the idea of a red team, and I think that would be great. In other words, because a lot of, even the Productivity Commission sometimes, will take, the relatively easy way out of, hey, let's just come up with a regulatory solution sort of thing. They don't usually. The Productivity Commission is pretty good on that front. But to actually have people who can argue, well, you know what, your problems are actually from regulation, so why do you think more regulations are going to solve your problem? Just to have that kind of...
So you want two analyses with opposing opposing
Yeah,
views.
and that's fine if it's a dissenting opinion, but at least you can kind of see it. I mean, that's obviously standard practice in courts. You know, if the judge thinks, you know, if one of the justices thinks, well, no, that goes on the record at least, and it can be brought up again. It can be, you know, it might actually become the majority decision someday. So, and then a year later, you know, to actually start legislating for, you know, hopefully a comprehensive reform agenda will come out of, you know, a royal commission or something similar. And I, you know, obviously hope, as we've been arguing, that we'll focus on the removal of regulatory barriers, not just sticking in different regulations that actually won't solve the problem and most likely will make it worse. And then give that, you know, something along the lines of a few years to actually implement that. I'd like to see a process, and maybe even some of the same institutions like the National Competition Council, because I think, you know, we haven't seen good reform in Australia for a heck of a long time. Really, the 90s, under competition policy, where they, you know, it had its flaws, and they didn't do everything well, but it was pretty good overall. I was there, I helped implement it. I think a process along those lines, which brings, you know, they brought everybody along. They brought state governments along for the ride. And even, say, for instance, in Queensland, they brought local government along for the ride. Now, that's not relevant for banking as such, although you do need to bring the states along for the ride, not local government.
Thank you very much. We've run out of time now.
Thank you.
Thank you, Mr. Nelson. And the committee will now suspend and recommence at 10:45 a.m.